Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Andrew, we're back again for another episode of the 360 Money Matters podcast.
Yeah, good to be back, Billy. Good to be back and running through it all.
Absolutely. So today we're going to be talking about a topic that seems to get everybody quite excited, talking about shares versus property.
Yeah. I mean, look, it's the name of the podcast. It's things that people talk about. It's shares versus property, but I'd like to maybe throw a spanner in the works there. And as a financial advisor, say shares and property should form part of, or at least a portion, if not all of the wealth in a client's portfolio. So yeah, hopefully it's not one or the other. It's not a trying to beat each other, but rather how do you take advantage of both?
I think we might have to change the title of the episode, Andrew, for sure. Just before we delve into that, we just want to talk about the previous 6 episodes that we've recorded. And if you haven't had a chance to listen to them, go back and have a listen. Essentially what we did is we ran through our 6-step process of what we go through as financial advisors and the journey that we take our clients on throughout that financial planning journey and that stage that we go through with them, and really outline what all of those steps are in the first 6 episodes of the series. So if you haven't had a chance, go back and have a listen to those, because that's a really good insight into what we do day in, day out with our clients.
Yeah, absolutely. And that's really good starting point and a real nice high-level summary of sort of getting started on a wealth creation journey. And so what we'll be doing sort of moving forward is a few different things, but taking a deep dive like we are today into, some more specific topics around benefits of certain asset classes and things that you can do to improve your wealth, as well as we're going to have some guests on, talk about, more specific areas that aren't in our wheelhouse and expertise, and also take some questions and scenarios from listeners that have sent in.
So essentially, weekly podcast that we're doing, and we're going to be mixing it up across 3 different areas. So a topic deep dive, we're going to have guests on, relative experts in their field, and then also questions that we get in from our listeners and case studies that we get from our clients to be able to share with our listeners here today.
Exactly right.
Fantastic. So let's get into it. Not shares versus property, shares and property. So we might start with a real simple overview, just in case some of our listeners aren't quite sure, but we thought we'd just clarify. But Andrew, what is a share?
Yeah, I mean, look, a share is purely ownership in a company. That's what it is. Now, a share can come in various forms. It can be a publicly listed company that's on the stock exchange and traded day to day. It can be private shares in a private organization. There's, different types of shares, which we're not going to get into a whole heap of detail, but really it's purely just ownership of a company.
Pretty straightforward.
Yeah. And there's a few different types of shares that you can have, and sort of the more common ones that we see in an investment portfolio, the more common ones that we see in a wealth creation journey. Take us through it, Billy.
So look, pretty straightforward. We would have seen or heard of a lot of companies in Australia that we're used to. So there's Australian shares, things like we're all used to interacting with on a day-to-day basis, the big banks or the big 4 banks, the miners that you see and hear about on TV all of the time, the supermarket chains. So in terms of the type of shares, you've got obviously the Australian shares that are listed on the Australian Stock Exchange. Just like you've got companies in Australia, you've also got companies overseas. So we refer to those as international shares. And then if you dig a little bit deeper, you would have heard things like blue chip shares, speculative shares, things like that. Essentially, the word blue chip is kind of the cream of the crop. So your bigger companies that you're used to, they're really predictable in terms of their performance. So you'd expect that those types of companies continue to grow and pay the shareholders distributions and dividends and profits. And those ones there in particular are some of the big names that I was talking about before. So that tends to refer to most of the shares that I guess our listeners probably would have heard of day in, day out.
Yep. And then the other thing is sort of comparing the other side of the equation. When we think about property, it's very common. It's something that most people, when you're thinking about investing, when you're thinking about growing your wealth, most people think of really just one type of property, and that's residential property that other people live in or you yourself live in. So that's really the most common type of property when you're, looking at anything from an investment side of things. But above and beyond that, there's also commercial property. So property that's utilized in a business sense and utilized by either a tenant or an owner in a business capacity as opposed to a private residential capacity. So there's a couple of different types of property. And above and beyond that, there's run through it a little bit more as we go through this segment in this podcast. But above and beyond just ownership of one property, there's also owning property through a fund manager, owning property through alternative holdings, where it's not just you purchasing one asset, but rather a pool of people purchasing a pool of assets.
It's a really good segue, Andrew. So some of the differences that we see between owning shares versus owning property, and different asset classes like these two that we're describing today, they do perform differently in different markets and there's different characteristics. But one of the things that we wanted to point out, which is probably blatantly obvious to most people, but we'll go through it, but it's the cost of entry. So effectively with a share, you can purchase a particular share on stock market for a relatively cheap transaction cost. I mean, obviously you're going to pay for whatever the share is trading at that particular point in time, but you go through a stockbroker and they will charge you a small amount of money, or you go through one of those online broking platforms and there's the transaction cost in order to buy the share. Relatively speaking, in the grand scheme of things, that's quite cheap. So shares are very, very easy to get into and out of because the transaction costs from that perspective are quite cheap. Whereas if you compare it to something like property.
Yeah, like property, the entry costs and the time to enter the market is significantly, more delayed and more cumbersome to get into. So when you think about purchasing a property, really what you're going to be doing is very likely getting your pre-approval if you're doing the right thing before you start bidding on a property. You're then having to source and look for the right type of property. You're going to have settlement terms that are generally going to be 30, 60, sometimes even 90-day settlement terms. So the time frame to enter a property, as well as the costs involved as well. So the largest of which in some instances can be avoided if you're a first home buyer is stamp duty. That's a very large entry cost if you're purchasing into that type of investment, which can have its benefits, Billy. It can, I don't know if it's benefits to pay tax, but it can really sort of determine whether it's the right type of asset to be entering into.
Yeah, 100%. So along with stamp duty, the other big key or the other big entry cost associated with property is having a deposit to be able to put enough money forward. And we'll talk about the ability to borrow against the asset and what you're going to need in order to get into a particular property. That seems to be the other thing too. And depending on how much you're borrowing off the bank, you're going to need to save up a particular amount of a deposit. And as we've seen, at least recently in Australia anyway, property is getting more and more expensive, and the amount of money that you need for a deposit in order to get into that property continues to grow. So it's kind of like you're chasing your tail because your savings are growing, and so is the deposit required in order to get into the property. Plus you've also got stamp duty with most transactions that sit on top of this as well too. So they're probably the two main differences between the barriers to entry around shares versus property. And I guess from a transaction cost perspective as well too, if we look at the flip side about when we exit property as well, or shares, I mean, once again, the share's pretty straightforward. You just put a sell order in to your online trading platform or with your broker, click a few buttons and away you go. And it costs a couple of bucks, or depending on what platform you're with, it's relatively cheap. Whereas if you want to sell a property, obviously you need to engage with a real estate agent. You need to get it on the market. There's a marketing campaign. You may need to dress up the property and prepare it for sale. So there's a whole heap of things that you need to do from that end as well too.
Yeah, there's engaging with a conveyancer. There's a whole heap that goes into selling a property, which can make it very difficult to exit that position. And that's why in any of these assets, you want to make a very informed decision as to A, whether that's the type of asset class that you want to be getting into, but B, whether that's the right asset that you're going into. But I dare say it's probably even to a larger degree with property, given the relative expensive cost to get into it, given the cost to exit it, as well as the liquidity in order to get out of it. You have to be making a very informed and a very direct decision that it's the right type of asset to be going into if you do decide to embark on purchasing a property.
100%. We probably see that a fair bit in our game and in our industry, that purely because of, I think it's purely because of this, but purely because you can leverage with a property, and we'll talk about that in a minute, but you can leverage with a property in order to get in. So essentially what that means is that you're borrowing money in order to get into that particular asset or facilitate that purchase. Now, what we find is if you're buying a property that's worth, we might just use some arbitrary numbers here, but if you're buying a property that's worth $600,000 and it increases in value by 10%, the absolute return on that is $60,000, which is quite substantial. Whereas if you buy shares and you spend $60,000 and you get a 10% return, your absolute return is only $6,000.
Yeah, correct. So it's really the power of leverage, and that's something that property really has the real benefit over share investment or an equities investment is the fact that you can leverage and borrow money in order to invest. As Billy just highlighted, it can absolutely magnify your gains, but as long as you're well aware and as long as you're sort of going into it with open eyes, that it can also do the same thing on reverse. So if in that exact same scenario, if the property market went down by 10% and a similar investment went down by 10% in a share portfolio, you're not experiencing as much of an absolute loss, you're experiencing more of an absolute loss because of the fact that you're, not only losing the money that you've invested, but you're also losing a portion of the money that you've borrowed in order to facilitate that investment.
Well said, Andrew. And something that you mentioned before, liquidity differences between the two. So we did touch on how easy or difficult it is to exit out of a particular asset class. One of the things that we often find is when family circumstances change, and we'll just use a hypothetical where you've got two owners of a property or two owners of an asset that are in a relationship together and maybe they split up. Exiting a stock holding or a share holding, like I said, is relatively straightforward and it's relatively cheap. But being able to do that with property becomes a lot more difficult. You can't sell half a property. You can't sell off one bedroom or the driveway if you need a little bit of money here or there. So the difference that we see between the two asset classes from a liquidity perspective is quite significantly different as well too. And I guess from a property perspective, that tends to work in its favor when we look at things like investment returns, because it's a lot harder and a lot more expensive to sell property. Therefore, in our experience, people hang on to property a lot longer, which is exactly what you should be doing with your investments. They should, generally speaking, be longer term in nature. So from that perspective, we're seeing that that's one of the characteristic differences between the two, but it works in favor of property.
Yeah. And sort of while you're on that topic and while you're talking about it, it's, I think, relevant to use, an example, right? And one such example, and obviously, the disclaimer that this is very generic and genuinely not intending to provide any advice here. But if you take an example of a retiree client that's considering purchasing a property or purchasing a bundle of shares, putting whatever type of money or whatever the value of the asset is, say that's $600,000, putting $600,000 in a property means that if you own that property in whole, you're receiving the rental income from it, which is great. But you want to go on a holiday, you want to gift an amount of money, you want to do anything else with, outside of just investing, you only have the option to sell that property. As Billy said, you can't sell a portion of it, you can't sell part of it, you can't really do anything other than keep or hold. And you compare and contrast that with someone that's investing that same amount of money in a bundle of shares. You can rely off income from those investments in the form of dividends. But if you need to go on holiday, if you need to utilize those funds for any reason other than investment, you can sell a portion of those shares virtually overnight, have the money in order to facilitate doing it. So especially in scenarios like that, it becomes very important to make an informed decision, and whether that's utilizing a combination of both, whether that's going all in on one strategy, that sort of depends on the circumstances and the client, but really important things to sort of keep in mind when you're making a decision as to what asset class.
That's a key highlight, Andrew, and I think that's a key takeaway for the episode as well too, is with some really good planning, or even one step back, you really need to be clear about what asset you're going into for what purpose. What's the objective? What's the time frame? What does that look like? Because like we said, specifically with property, it's a longer term asset just by its very nature in terms of how long you need to hold it for. It is hard to get into because of the deposit requirements and the transaction costs associated with it. It's expensive to get out of as well too, and it does take time. So you need to really be clear about what it is that you're trying to achieve. So setting up and having a good investment plan in place, which is funnily enough something that we've spoken about in previous episodes, but you really need to begin with the end in mind, because if you do make a mistake with one of these and you need to exit or reverse your position, it does get very, very costly and does get very, very expensive as well too. So well said, and I think that's a key takeaway for our listeners today. We've also got different ownership structures that we have available to us for both of these asset classes. Andrew, you want to run us through what some of those ownership structures are?
Yeah, I mean, when we're talking about ownership structures, we're talking about how do you actually own the asset. So the normal way that most people think about owning an asset is you purchase it personally. So Billy Amiridis purchases a property himself, he's the sole owner of that property. There are some other ways. There's a fair few other manners that you can own property. You can own it in, a company. You can own it in a trust. The other way is to own property not just property, but the asset. So whether that's shares or property, you can also own it through superannuation, which is another trust in itself. But some of the ownership structures will change what type of assets you buy because of tax implications, because of the complexities involved in it. So take us through that, Billy. I mean, there's some differences in particularly around property. What does it entail when you're owning property through superannuation? I mean, if you've got just standard super fund, is it possible?
It's one of those episodes we're going to do a deeper dive into, but essentially what you're looking for when we're talking to clients in terms of what ownership structure they're going to purchase their assets in, a lot of it comes down to, in my opinion, one of two particular things. The first one, which is the word that you touched on before that everybody absolutely loves, is the tax. So if you can own a particular asset in a particular structure where it gives you some tax advantages. And one of the episodes that we're doing in the future, we are going to have an accountant that comes in and talks to us about this specific topic, which will be a deeper dive into the tax implications around that. But the first thing that we talk to or see our clients wanting to avoid, or I should say minimize, is the amount of tax that they need to pay. So usually that's the first port of call, or that's the first part of the decision-making process in terms of which structure that you buy a particular asset in. The second one that we see, and this is a lot more common, I think, for our business owner clients, is looking at ownership structures from an asset protection perspective. Once again, a bit of a topic to do a deeper dive on further into the series. Once again, they're the two things that we see most often when we're talking to clients around how do they own a particular asset. They're the two things, generally speaking, that they're trying to solve for. How do I minimize my tax? Legally, of course. And from an asset protection perspective,
minimize, not avoid.
There's a significant difference, Andrew. Absolutely, absolutely. But they're the two questions that they're trying to answer. How do I minimize my tax? And how do I protect my assets? And that becomes significantly important, especially if you're a business owner, you're a company director, you've got guarantees, you've got liabilities in your name. It's a really common problem that we face with a lot of our business owner clients.
And Billy, I've got another question for you. It's something that I know that you probably do, because I definitely do here all the time. And but property doesn't go down in value. It doesn't move. The share market is always constantly up and down. Is that true? What's the go with that?
No, it's definitely not true, is the short answer. The long answer is probably this. When you look at shares, and the majority of the types of shares that we know, they're traded on a stock exchange, and they're traded between 10 o'clock in the morning and 4 o'clock in the afternoon. It's on a public register, which means you can essentially get the share price of any particular company in real time and see how that's trading. What that does is you can determine what your asset is worth at any particular point in time. And if you don't like what that looks like, you can then make a decision to sell it on the spot. Something like property, because you don't know, there's no public register, it's really, in most instances, it's either a private sale or it's an auction. You don't actually know what your property's worth until you've got somebody putting an offer down, or there's a public auction or something to that extent. So when property does decrease in value, we don't actually know, because we're not looking at the stock market like the same way that the stock market has the numbers published every minute of every day. Whereas with property, the only real way to know is to test the market. There's a lot of data that comes out every weekend after all of the properties have gone for sale for that particular weekend. So we can pick particular trends and which way the property market is going. But the short answer is, I think that's the reason why there's this idea that property always goes up. And I guess, look, if you look at particular asset classes, and we'll talk about these two in particular, but if you look at the historical valuation and the returns that these asset classes have got, it is fair to say that the assets have continued to grow in value.
Yeah, exactly right. Exactly right. If you look at it, on a long-term basis, when you're comparing purely just the Australian stock market versus the Australian property market, by percentage, the stock market has increased at a faster and more rapid rate. The thing that people don't recognize is that, yes, you're seeing the fluctuations as Billy outlined in the share market because it's valued of every second of every day. Whereas the property market's so much harder to value, and you can get 5 people go through the exact same property that are experts in their field and will come up with slightly different variations on property, but you're not seeing that every second of every day, so you're not actually seeing the fluctuations. But on a longer term basis, which is how we think that every asset should be viewed, that's the approach that you need to take. Not what is it today, what is it tomorrow, what is it next month, but rather what's it going to be in 1, 5, 10 years time in order to facilitate my wealth creation and goals that I want to achieve from these asset classes.
Well said. One of the main differences between the two as well, Andrew, and I guess it's because with most property transactions, it's fair to say that there's debt associated with the purchase or there's leverage, is the cash flow requirements in order to service that particular asset.
Yeah.
So you want to start us off and talk us through that, Andrew?
Yeah, I think totally agree with that. I think there is another comment in it as well, that just because historically, or just because most people think of being able to take debt against property and that being sort of a normal thing to do, there is the option to also do that in a share investment as well. So particularly around margin lending is what it's called, but you can take some of the advantages and the leverage around borrowing against an asset, much like you do with property, in a share investment. Now, there's some different risks associated with it. There's very different structures that you need to, or very different considerations that you need to take with it. So again, sort of park that for another podcast to go into a deeper dive around margin loans. There is that option to sort of take advantage of the best of both worlds and take some of the benefits of property and input that into an investment like a share investment. But what Billy was specifically alluding to is if you consider the form of purchasing these types of assets, most of the time, if you're purchasing a bundle of shares, you're purchasing that with your own money. So you put the amount of money in, now you can choose to add to it on a regular basis, but that's as a matter of choice rather than being absolutely forced to have to do so. As opposed to you purchase a property and very few people have median house price in Australia, you're talking of close to $1 million, but very few people have that amount of money lying around where you're purchasing it with your own funds. And so you're facilitating that purchase through borrowing. Now, what comes with borrowing is having to make repayments on that property. There are ways to, obviously limit that impact, and that's, rent the property out, generate an income from it, but you have to take into consideration the cash flow requirements, not just what it is best case scenario if the property is rented out, but what are the implications if things aren't going to plan, the property is untenanted for a period of time, what are the cash flow implications and what are the things that I need to make sure that I've got covered?
Yeah, absolutely, Andrew. And one of those things as well, too, from a cash flow perspective, is if you're negatively, neutral or positively geared. I mean, those comments or those phrases, I'm sure our listeners have heard before, but in a real simple sense, if you're negatively geared, the amount of income that you're receiving, in particular, we'll talk about property, but the amount of income that you're receiving off the property is not enough to cover the costs associated with it. So from a cash flow requirement, you're required to contribute to that. Normally, we find that that's the case when there's a large amount of borrowing on a property, and as the borrowing does tend to get lower and lower and lower, those cash flow requirements do change. It becomes neutrally geared, where the amount of money that the property is generating as an investment return meets the cash flow requirements of the property. And then from a positively geared perspective, the property is actually bringing in more money than it's costing to hold that asset. So in terms of a negatively geared property, which is generally what we're seeing with a lot of investors, because there's some tax advantages to it, from a cash flow perspective, that investor will be required to put some money in to make sure that they're meeting the commitments of the cost associated with the property. And generally speaking, that's the borrowing requirement. So making sure that you're making your monthly repayments month in, month out to the bank or the lender that you've got the loan with.
Yeah, so that's one of the important risks to really consider when you're purchasing, in particular a property. Now, there's risks associated with either of these asset classes. However, really when you're talking about a property, the risk associated is primarily around, meeting the income requirements, meeting and continuing to pay your debt obligations to the bank around facilitating the mortgage repayments. So there's a really sort of big risk that's involved that I think it's important, and, we've spoken about it in the previous podcast, but it's important to have strategies in place and risk mitigation strategies in place in order to be able to make those mortgage repayments if your income wasn't coming in, if the tenants were no longer there and didn't have a rental income coming from that property as well.
Well said, Andrew. And I think a good way to summarise and sort of tie a bow around this, from our perspective, from an advice point of view, I mean, look, like anything, and it sounds a bit cliche and it sounds a bit like a throwaway statement, but it really depends on the circumstances of the client that we're dealing with or the person that we're talking to. From our general perspective, thinking about wealth creation, we try and do both. So from an asset class perspective, we don't have a particular preference. We don't lean one way or the other. We're quite general in that perspective. But if we had a choice and our clients are in that position and it suits their goals and their circumstances, we'd actually recommend that they do both, that they'd buy property. And once again, depending on their circumstances would depend on what type of property that they got, but we'd also recommend that they diversify their wealth creation and invest in a share portfolio or something to that extent, because that way, you don't know what's going to grow, you don't know what's going to go up or down in value. Once again, the theory of diversification sits at the heart of everything that we do, but we encourage our clients to do as much of everything as they possibly can if it fits their circumstances.
Exactly right. I mean, the more that you can do, the benefits of each asset class is inherent in that type of asset. So when you can hold not only property, but also shares, but also alternative asset classes that we'll run through as well, you take advantage of each of those types of asset classes. So you give yourself more options, more choice, and more ability in order to be able to facilitate your wealth creation. There are circumstances where you do have to make a choice of one or the other, and that's when you really need to delve down as to what is the right type of asset to be holding. And there are also, what commonly happens and we see all the time, is even though there's certainty that at some point in time you're going to own a combination of both of these assets. But considering that, as Billy said, it meets the circumstances and it meets what you're trying to do from a goals perspective, you're going to likely own a combination of both of these assets. The question isn't which one do you own, it's at what point in time do you purchase one and at what point in time do you purchase another. I think that's the real key when you're developing an investment strategy, is what's the right time to purchase a property, what's the right time to purchase a share portfolio, and what's the right time to purchase an alternative asset.
Well said, Andrew. So to our listeners, I hope you got a fair bit today out of our discussion on shares and property, and that we gave everybody a little bit more of an insight into these two asset classes and how we think about it and some of the issues and the challenges and the characteristics that each of those asset classes have. But once again, like always, if you needed to talk to or you wanted to talk to us about your own particular circumstances, feel free to reach out. There's some contact details in the show notes.
Yeah, thanks very much for listening. It was a pleasure to bring it to you all, and looking forward to recording the next podcast in the next week or so.
Beautiful. Thank you. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.